Hi, we're back. Freedom Day's just gone by, so we're celebrating. Welcome to Beers with Rich. I'm Rich, editor of Under the Radar Report, and we can all see a glimmer of sunlight out there, although it's very cloudy and thundery outside. Summer every day now. And speaking of celebrations, this week's beer is a special one. That's right, Fiji Bitter. The beer we drink around here and in Suva. Because we're celebrating Fiji's Independence Day. So let's crack it open. Bula Bula! I love watching Fiji win the sevens, so well done boys. Sarivi would have been proud. Well, Fiji's independent. Oh, jeez, that's not bad. The taste of a nation. Fiji's Independence Day was last Sunday. And so I think they were originally taken over in 1874 by Britain, and then they gained their independence on the same day in 1970. So it's been a rich history and one worth celebrating. So here's to Fiji. I'm going to mention Fiji a bit later. But today what we're talking about, there's a sort of a portfolio management theme. And I want to talk about how buying some sort of what might seem on the face of it boring small caps can actually reduce your risk and improve your returns. That's right, you get the double whammy. Plus 3 more future facing small caps. It's all on Beers with Rich. That deserves another Beer with Rich. This week I actually looked at 2 regional banks that we've been covering for quite a while. Tasmania's MyState and Queensland's Auswide. Like 2 banks I've got to know pretty well over the years. These stocks have been like the mainstay of our dividend portfolios. So they've been, really good performers. They've been running hard lately, but importantly, they've been consistent dividend payers. You look at their yields are now over 6%. There's no reason that's going to stop. But it also reminded me, like couple of years ago, I think it was 2 or maybe 3 years ago, I met Auswide CEO Martin Barrett, and he was complaining that some fintech or another had raised more money than his entire, his company's entire market cap, with, which at the moment sits around 300 million. So maybe it was around 200 million back then. But I think, like I thought back then, I don't know whether I'd be complaining if I was you, because I think he was selling his company short. Because the thing that I like about Auswide, which, not just their sponsorship of the NRL, and their association with Queensland State of Origin, but the thing that I like about them is that they're attractive to what I class as sticky capital, which is you and me, which is retail investors, rather than that flighty wholesale market. So they've got a strong balance sheet, stable earnings, they pay dividends. So they attract, not flighty capital, which is the case with that fintech you mentioned. Like with these sort of companies, if they don't produce growth from the get-go, they'll probably be out of business. That fintech you mentioned might well have just been a fly-by-nighter, because it happens more often than you think. It's not unusual. Like there's only one Afterpay, there's only one Zip. There's 1,000 others that have fallen by the wayside. So these companies provide what I like to call ballast for the portfolio. And I like them because they're small caps as well. And I was like ballast in my sailing days, But what I like about ballast is that in these small cap sort of stocks, is that they provide good certainty. So at the moment, you can't just be on the growth bandwagon. Like, sure, you want sex appeal in your portfolio, you want irons in the fire, but these irons are going to be burning no matter what the conditions, or they're more resilient. So, basically with inflation pressures on the economy, these growth stocks are vulnerable. These companies are less vulnerable. The question, I guess, that brings to mind is, would you invest in these guys rather than in CBA, rather than in NAB, rather than ANZ, rather than in Westpac? Well, in my opinion, you're getting compensated for that, increased risk that these small caps have with a superior dividend yield. But you're also, and they don't have the big bank advantages, so you're getting compensated for that, but you also get superior returns. You get superior returns because it's off a smaller asset base, it's off a smaller equity base. Like if I can come back to our good friends at Fiji, Bula Bula, when international travel resumes, and we're on the cusp of it, you'll get a much bigger rebound effect in Fiji than you will in Australia. Why is that? Because tourism is basically, a much bigger percentage of their economy. Like that country revolves around tourism. In Australia, like it's an added benefit. So you get a much bigger multiplier effect. Plus, they didn't get JobKeeper. So those businesses are going to be rebounding doubly. So our businesses have really been held up by JobKeeper. So that's why I think small caps, where you've got that kind of resilience, they can explode out of the gates. Like Tasmania is going to go crazy. And that's where MyState is. So, you're going to get a much better leverage bang for your buck when conditions improve by buying MyState than you're going to get from buying CBA. And that's not to say growth doesn't have its place, and sexier companies with leveraging those future themes I talked about doesn't have its place. And at the moment we're covering a lot of those stocks, and I'm just going to mention 3 of them to keep an eye on. Hastings Technology Metals is the first one. So this is only the second rare earth company to get into production in Australia after Lynas. So it's a big deal. It looks like Hastings will be mining here and processing here near Kalgoorlie. So rare earths is quite risky because the technology is difficult. So there's more certainty in our opinion than nickel and lithium, but Hastings does look exciting because it's leveraging and running off that EV theme. Another stock, Echograph, well, that's been hit hard lately, but it's also battery related. They're producing spherical graphite for battery anodes. Now this is also highly speculative along the lines of Novonix or NVX. So Echograph has a project in Tanzania, and it's establishing a sort of centre for production in WA for producing battery anodes. So speculative because there must be all sorts of organisations trying to do this everywhere. So when you're looking at a big manufacturing hub in Australia, well, you'd have to ask questions, in terms of risk. But, and the stock's sort of down, so the market's saying something. Playside Studios, well, I have to mention Playside Studios. I mean, gaming just seems to be taking over. They develop these games. And as they say in Fiji, you're only as good as your last game. Thankfully, Sarivi had a lot of them. He used to Fiji Sevens. But it seems as though they're getting some traction, Playside, with this new game called Animal Warfare. How can you not finish with a name like Animal Warfare? So if that's not a good note to finish on, I'm a monkey's uncle. So what's coming up? We've got a hot new medtech we've been working on. Dividend portfolios, more future-facing stocks, and you guessed it, more beer. Cheers to you.